Let's talk about the American economy. The number of initial jobless claims in the United States has come in below expectations and now are seeing those decrease by 5,000 to 2,27,000 in the week ending 31st August. And at the same time, taking a look at crude oil prices, OPEC Plus nations have decided to pause their planned supply increase for 2 months at least. And we're seeing Brent crude react to that news, jumping on the back of this decision by OPEC Plus. But the question we're asking tonight is, what will be the quantum of rate cuts now? What will be the pace of rate cuts now? And how will crude oil prices impact the Indian economy? What direction are markets likely to take when the Fed finally starts cutting rates in less than 2 weeks? To discuss all of this, Anurag Singh is joining us. He's managing partner at Ansid Capital. He's joining us from Chicago. And Santosh Rao is also with us, head of research and partner at Manhattan Venture Partners. Great to have you both, gentlemen. Santosh Rao, to you first. As of August this year, American inflation is 2.9%. It's the lowest inflation that the country has seen since March 2021. So, is it a fair question to ask that if inflation has climbed down significantly, interest rates have been high for a considerably long time, jobless claims are coming in lower than estimates, then shouldn't the Fed have started cutting rates already? Is it behind the curve in a way that will make the American economy shrink into some kind of recession?
Yeah, thank you for having me. Well, I think there are 2 or 3 factors going on. The whole issue is, how do you soft land this whole scenario? And you raised it 500 basis points. Now you want to bring it down slowly. So you don't want to do it too fast. There's a risk of causing panic if the interest rates are reduced too fast. Then there's maybe the Fed knows more than we know. That kind of a narrative kind of builds. So I think they're doing it gradually. They're doing a good job. And I think the narrative has shifted, or the debate has shifted, or rather the focus has shifted from inflation to full employment. I think that's where the action is. That's where the issue is. I think they want to focus there. So today's data was, the service side of the economy is still doing good. The number was fairly good. The other side is slowing down. The manufacturing and all that is slowing down. So net, I think the report was okay. Not that bad. He will stay on 25 basis point, as he has said already. Anything above that will, like I said, will set off a panic mode in that sense. You don't want to do that. Down the road, the issue becomes, does he do more 25 down the road or 50-25? We don't know that. That, yes. I think, is data dependent. But yes, at this point, I think 25 basis point, he's on the curve. He's doing it right. He's not behind the curve.
Anurag Singh, what do you say? Because at Jackson Hole, we heard the Fed chair, Jerome Powell, saying that the time has come for policy to adjust. The direction of travel is clear, he said, and the timing and pace of rate cuts is going to depend on incoming data, the evolving outlook, the balance of risks. And he also said it seems unlikely that the labor market is going to be a source of elevated inflationary pressures anytime soon. We do not seek, he says, or welcome further cooling in the labor market conditions. But looking at the labor data now, Anurag, with some pockets in the market supporting this 25 basis point rate cut in September, November and December, what's your sense of the size and pace of rate cuts that the Fed will go with?
So, Vikram, I concur with Santosh ji, which is that, look, they can't, first of all, there's no panic in the economy anyways, right? So there's no point. Markets can behave and do what they do, but the economy overall is just getting back to normal. I mean, you see all the, the unemployment rate, quits rate, hiring rate, ratio of unemployed to jobs. Those kind of numbers are just about getting back to where they were in 2019 or 2020, just before the pandemic started. So I think it is all very good news, but there is nothing which, signals a slowdown. All leading indicators just say that it is just back to getting normal. The other point, Vikram, Federal Reserve has to keep in mind is, what is the runway they have? Look, they started from 0%, right? And which was anyways a very, abnormal, emergency measure. And never mind, the emergency was underway since 2008.
Yes.
It went way too long.
Yes, the financial crisis, then the pandemic. Yes, indeed.
Absolutely, right. So the point is, you now are not going back to zero. So what is the end run rate that they have? So my sense is, and the various experts, projected around 3.5 to 4% is basically the normal run rate.
Right.
And that leaves just about 150 basis points to 200 basis points for them to really get to,
Right.
which is just about like
And the
8 cuts.
pace,
So
Anurag?
yeah.
The pace?
So the pace, I think, Vikram, 25 basis point is apt for these, the two rate cuts this year, and then followed by six more in the next year,
Sure.
which will be like six cuts overall back to 4%.
Okay.
And unless there's something more panicky coming
Yes.
in, I don't think they need to go faster than that,
Right.
Vikram.
But Mr. Rao, what do you expect of Wall Street once the Fed does start cutting those interest rates? Because typically when rates are cut, the US dollar weakens and US goods become that much cheaper to procure. So do you think export-oriented stocks are going to rise?
Yeah, absolutely. I think rate cuts always helps the dollar. I mean, reduces the dollar, so that's good for exports, good for emerging markets. So I think that's where you'll see. I think Wall Street, I think, is generally anticipating. It's pretty much priced in that they will start cutting. 25 basis points is definitely priced in. I think it's still expecting more cuts. I don't think they're going to get that, but that's okay. Wall Street is fine with for the growth stocks, but you want rates to come down for the right reason. You don't want it to come down because the economy is slowing and we're heading towards recession and all that stuff. And that's not good. So I think right now, as of this point, I think the general view is that the economy is on good footing. The fundamentals are okay, and we're entering into a seasonally very volatile period. September, October, there's always turbulence. There's tax loss selling. There's a lot of technical factors as well, besides the economic factors. And then you have this geopolitical tension building up on the side. The oil prices, we don't know where that's going to go, but that's more a function of supply demand there. So I think all those cross currents are playing definitely. But at this point, I think it is definitely there is no panic mode in the stock market. They are welcoming this
We
rate
are
cuts.
concurring on no panic mode in the markets right now, but crude oil prices, you said that it's a demand-supply kind of scenario. Looking at crude oil prices today, of course, we've seen them trend down in the recent past, but now that OPEC Plus has reached that decision to not go ahead with a hike in production, the kind of effect that is already playing out in the markets. I'm looking at WTI right now, which has gone above $70 a barrel. So Anurag, once the Fed starts cutting these rates, will it increase demand for commodities like oil and metals, you think, and push up their stock prices in the bargain?
Very difficult to say, Vikram. One is this whole China economy has made all the indicators go haywire. So you can't now look at a copper demand and say, what it says about the economy. It used to do that before, but since broadly about half of all the metal demand was coming from China in the last decade, that has made the forecasting very difficult and very dependent on the way China behaves, right? And we don't know how that goes. So it's kind of very tough on the metal side. I would be very skeptical, because if China is slowing generally and not building at the pace at it was before 2020, then I don't think metal demand will be persisting on the rate it was. On the oil, Vikram, I think we'll have to just wait for US elections to be behind us to actually know what is the normal level of oil. Before that, everything else is kind of focused towards keeping the oil prices low. And I don't think that's the normal balance of crude oil. My sense is the prices should be around in the range of 70 to 80 and should never be below 70. But we'll find out once the elections are over in November.
That's, of course, a big moving piece, the outcome of the presidential elections in the US. We are constantly tracking that. But Mr. Rao, tell me about the bond prices. How do you expect them to move once these interest rates start falling? Typically, bond prices would rise, which helps existing bond holders, but the new bond buyers, they could get lower returns, right?
Yes, absolutely. And I think that was expected. People locked in their low rates for the last few months. So I think that's going to play out in the market. But I think generally the bond market is as far as there is no inflationary expectations and things are back to a normalized level, they will continue to do well. For the first time after a long time, you can make money both on the bond side and the stock market. The 60-40 thing will come back in play. So I think those things are definitely playing out. That bond market will receive it well as long as the conditions, the outlook stays stable and there's no recession or inflationary pressure out there. So I think the bond market will do well.
You did mention some advantages accruing to emerging markets once those interest rates by the Fed start coming down. What exactly are the advantages that you see for the Indian markets that lie in store for investors here?
Yeah, I think it's any time the dollar falls and money starts flowing out, exports will go up. I think that's generally good for the emerging markets. So I think it's going to be net positive for India and other places where if US kind of brings down their dollar rates, brings down their interest rates, so money will go chase other places where their interest rates are much better. So all that definitely plays into place. It's going to be more normalized environment for the flows, fund flows, the interest rates, and the dollar and all that. I think that's what we want. We don't want this volatility. We want things to revert back to pre-COVID and the normal phase. So yeah, I think my headline is that it's good for the world economy if things stabilize here.
It's good for the world if the American economy stabilizes. Anurag, how far are we from that? Because the kind of benefits that we see accruing to Indian investors, whether it's the IT pack, whether it's through the capital inflows, because those could rise. Will there be a higher demand for the Indian rupee as well going ahead? What do you think are the factors that we should be watching out for that would be advantages to us if we have to position ourselves that way?
So one is Vikram, the world over, I think major democracies were facing elections this year. So I think once this year is behind us, and especially in November, once US has passed the elections, I think the IT companies in India can also start looking forward to at least a decision making with clarity. I think that, and that applies to pharma companies as well. So I think that is a positive for Indian markets and all emerging markets overall, right? Aside of that, I think we can also see these, the kind of movement towards settling these global disputes, right? Be it Ukraine, be it Middle East, or all of those, right? They have also been kind of beholden to the US elections. Outside of that, I think, Vikram, the only concern I have is the emerging market as a basket. If you see for the last 10 years, the returns from emerging market index MSCI has been like sub 3%. And that is causing the money to be pulled out of EM collectively.
Right.
And that's where India also faces some of the selling off. It's not specific to India, but it's the overall EM basket.
Right.
And some of the other country keeps shooting itself in the foot. So I think that is something to be watched out even in 2024.
Right. Besides that, Mr. Rao, in passing, do you spot any potential risks that investors need to be mindful of while we expect the Fed to start cutting rates?
Well, it depends on what exactly are you talking about.
The kind of risk that Anurag was alluding to in terms of the potential risks to emerging markets, what we need to be mindful of.
Well, I think at this point, I think it doesn't look like he said, let's see where the election comes off. Let's see what the tax proposals are. Are there going to be tariffs and all that stuff? So there are a lot of moving parts there. We don't know with the candidates where they stand. But other than that, I think stay with quality. That's the main thing. That's what we are advising here as well. I don't think this is a time to really go out on the risk curve too much because there's still a lot of volatility in the air. But emerging markets, hey, just I think they are better off just hoping that US gets its act together and doesn't just go out doing this deficit spending more and more. They need to get their fiscal scenario in check. So I think those things are playing out definitely. Everyone's watching. If the inflation is controlled here and things are more normalized here, I think they will. The rest of the world will see the net benefit.
So quite sanguine that things are moving in the right direction in the American economy, and all in all, Fed rate cuts can create opportunities for investors. They could get higher returns. It also comes with a fair share of risk, particularly when you talk about currency rates. When they become volatile, there are some potential asset bubbles also that come to the fore. One needs to be watchful, and I'm sure investors are, but it always helps to get expert advice from people like you, Anurag Singh, Santosh Rao. Thank you very much for joining us with your perspectives on this edition of India Tonight.
If you like this video, then like, share and subscribe to ET Now.